Hello everyone, warm welcome to Supercoaching Regulatory Bodies YouTube channel by Testbook. My name is Madhav Sir. I welcome you all in a very important session where we are going to discuss about a very important term, that is IBOR. I'm not sure that whether you have heard this term or not, but this is one of the most important terms in the recent times, which stands for Interbank Offer Rate. And the next term we have is ARR, that is alternative reference rate. What is Libor? What is IBOR? How it is different from ARR? What was the requirement of shifting to ARR? That will be discussed. After discussing these questions, I will be discussing with you what is SORR. In the recent monetary policy, which was presented by none other than Reserve Bank of India, they have discussed in much detail about this particular term, which stands for what, sir? Which stands for IBOR as well as ARR, and we will be discussing the SORR. So before I start the discussion, may I have a reply in the comment section that I am audible, visible, everything is fine, we are good to go, so that we can start the discussion without any further delay. I'm pretty sure you're going to enjoy today's discussion, and many important things are going to be discussed in this particular session, which is going to be really very important for your upcoming examination. If we are good to go, just give me yes sir, so that we can begin the discussion without any further delay. Quickly everyone. So first of all, I'll start my discussion with the first term, that is Libor. And how Libor is linked to Reserve Bank of India, that will be discussed, and many more things will be discussed in this particular session. Okay, thank you Priyanka, thank you Rutra for the reply that yes, I am audible, visible, everything is fine. Before we start the discussion, we are, I guess, missing something, and that is we have not yet shared the link of this session with our friends so that more and more students, they can join us live. So I'm doing it. You do it along with me. Copy the link of this session, share it with your friends so that more and more students, they can join us live. And the moment you have shared the link, just give me yes sir in the comment section, and then we'll begin the discussion where your first doubt, that what is London Interbank Offer Rate? What is Interbank Offer Rate? That will be clear. Second doubt is what is the alternative to the same? That point will be clear, and many other things are going to be cleared in this particular session itself. Got it guys? So let's begin the discussion. My first question to everyone: how many of you have heard this term, that is Libor? How many of you have heard this term, that is Libor? May I have a reply please? How many of you have heard this particular term, that is Libor? Any idea? That is London Interbank Offer Rate. See, whenever we use this word London Interbank Offer Rate, or for that matter, if we use this term, that is Interbank Offer Rate, as the name suggests, these are the rate of interest which are charged by the banks when the banks they are borrowing or lending the funds for short term to each other. What I'm trying to say, I hope you all are very well aware of the term, that is LAF, which stands for Liquidity Adjustment Facility, which basically means with the help of repo rate, with the help of reverse repo rate, with the help of SDF, with the help of MSF, banks, they can manage their overnight balance. If bank is having surplus funds, bank can transfer those surplus funds to RBI. If bank is deficit, then bank can even borrow the funds in order to manage their overnight balances. Now, if a bank is not in a position to borrow from RBI, maybe because of unavailability of the government securities, which is required in case of repo rate, as well as if the bank has already exhausted its entire marginal standing facility limit, then what could be the next solution? The next solution is banks, they can borrow from each other, which means ICICI can borrow from SBI, SBI can borrow from HDFC, and this borrowing is done against a paper which we can say a promissory note that is known as call money bill. and you must be aware of the term that is call money market. It is basically a market where overnight borrowing and lending is done between the banks. And if you want to borrow for more than one day, more than 24 hours, we call it as notice money market or notice money bill. That is a point. Even we have CBRO, which stands for collateralized borrowing, CBLRO, that is collateralized borrowing and lending obligations, which is basically related to other financial institutes like insurance companies and other financial institutes. If they want to borrow the funds or lend the funds for short term, they can done in this particular market. Now, the question is, the most important question is, sir, whenever the borrowing is done between the banks, how the lending rate is decided? So the lending rate is decided on the basis of a term that is Mumbai Interbank Offer Rate. You might be aware of it. Ya fir they also use a term that is Mumbai Interbank Bid Rate. Now the question over here is, what is Mumbai Interbank Offer Rate? What is Mumbai Interbank Bid Rate? How these rates are decided? How they are related to London Interbank Offer Rate? And why RBI has asked the Indian banking system, or I would say the Indian financial system, to shift away from Libor and find out the alternate reference rates in order to make the interbank transaction. So we will be discussing about all this, I would say, part which I have just given you in a brief. So let's get started with the first point. The first point over here is, what is interbank offer rate? The moment I say interbank offer rate, the first thing which should come in my mind related to interbank offer rate is, whenever we use this word interbank offer rate, it basically means what? So interbank offer rate basically means whenever two banks, let's say bank 1 and bank 2, they are in need of funds, they can make their overnight settlements. How they make the overnight settlements? What is the requirement? What is the benefit? Please pay attention. Guys, let's suppose this is a bank. The bank is holding surplus funds. Now, what the bank can do? So bank can deposit, or bank can transfer this amount to RBI. And against this, RBI will be providing what? Sir, RBI will provide rate of interest to the bank. And what could be the rate of interest? Sir, it could be reverse repo rate if RBI has given government securities in return. And if RBI has not given any kind of government securities, then the same will be done under SDF, which is Standing Deposit Facility. As per the latest monetary policy, what is the value of reverse repo rate? So that is 3.35%. And what is the value of SDF? So that is 6.25%, which means, let's say if I am a bank 1, I will be going with the higher rate, and I know RBI is a trustworthy organization. If it is borrowing funds, if it is receiving funds from me, and that too without security, I am okay with it. Now on the other side, bank 2 is negative. That means bank 2 is deficit in nature and it is in need of funds. So this bank 2 will reach to RBI and they will be borrowing, or the bank will be borrowing from RBI. That could be against repo rate, which is 6.50%, and it could be MSF, that is 6.75%. Now, if I talk about both the banks, sir, what both the banks are doing? So both the banks, they are losing something. Why they are losing something? I hope Priyanka, I am audible, Priyanka. I hope I am audible. I hope the things which I am discussing with you are crystal clear. Do reply in the comment section. So just pay attention over here. So this is 6.25% and that is 6.5%, which means RBI is for sure earning a profit of 0.25% to 0.50%. This is the first point. Second point is, there are certain limits related to repo rate, MSF and the other borrowings and lending wala scenario. Now in this case, if these banks, they come together and bank 1, rather than depositing the funds with RBI, they transfer the funds to bank 2 for short term, and bank 2 is ready to pay the rate of interest to bank 1, this is going to be beneficial for both of them. For example, the current rates which are prevailing in the market is 6.25 and the other rate is 6.75. The other rate is 6.75. If bank 2 is ready to pay, let's say 6.35% against this borrowing, it will be beneficial for bank 1. Say yes. It will be beneficial for bank 2. Bank 2 is paying less. Bank 1 is receiving more. What actually is done? So the commission of RBI is being distributed. The commission of RBI is being distributed among the banks itself. It is distributed among the banks itself, and this process is basically termed as what? So this process is basically termed as interbank borrowing. And why interbank borrowing is done? So interbank borrowing is done in order to manage surplus funds as well as deficit funds, and generally the interbank borrowing is done for short term, 24 hours, 48 hours, at max 14 days, in order to manage their day-to-day balances. Is it clear till this point, guys? Is it clear till this point? If it is clear, just give me yes, sir. If it is clear, just give me yes, sir, so that we can move ahead. If it is clear, just give me yes, sir, so that we can move ahead. I'm waiting for your reply. Guys, if it is clear till this point, just give me yes, sir, so that we can move ahead quickly. Done? Clear? Done? Clear? Chalo. Now, let's move ahead and now let's jump on a term that is LIBOR. Now, the question is, what do you understand by the term Libor? So, Libor stands for London Interbank Offer Rate. Now, the question is, what is the meaning of London Interbank Offer Rate? So, whenever banks like B1 and B2, they are making the transaction within India, that is interbank borrowing or lending, but not only the interbank transactions, in many cases, the rates of derivatives, in many cases, the rates of futures, in many cases, the rates of currency swap agreements, these rates are decided on the basis of offer rates. And these offer rates in India are termed as Mumbai Interbank Offer Rate. And these Mumbai Interbank Offer Rates are based on London Interbank Offer Rate. They are basically based on London Interbank Offer Rate. So which means if you want to understand how MIBOR is decided or on what parameters MIBOR is decided, you need to understand what basically Libor is. You need to understand what basically Libor is. You need to understand what basically Libor is. Is it clear till this point? Now, let's try to understand the term that is Libor. Libor stands for London Interbank Offer Rate. London Interbank Offer Rate is what? So it is basically a benchmark interest rate. Which is used by major global banks to lend or receive funds from each other, to lend or receive funds from each other, and this borrowing is done for short term. Now, short term means it can be as short as 1 day, and it can be up to 1 year. How does Libor work? Sir, how does Libor work? Libor basically, it is announced by ICE Benchmark Administration. ICE Benchmark Administration is the responsible authority which comes up with the rates, and it is based on 5 currencies. These 5 currencies are US dollars, Euro, British pound, Japanese yen and Swiss franc. It is by Japanese yen and Swiss franc. So please pay attention. See, lending and borrowing done between the banks is done on the basis of Libor. The Libor is also used for security swap agreements. Libor is also used as a benchmark for derivative decisions. It is also used as a benchmark to decide the rates of the forwards as well as futures. Now, why it is not credible, why we are shifting away from Libor, let's try to discuss this point in much detail. So the first point is, so what is London Interbank Offer Rate? As I said, London Interbank Offer Rate is the offer rate which is basically used by the global banks in order to borrow and lend funds for short term. Short term means from overnight to as long as 1 year. Libor is also used as a benchmark for many other transactions in the country, which is let's say derivatives, futures, currency swap agreement, options, and many more. So Libor, London Interbank Offer Rate, is basically used as a benchmark. It is basically used as a benchmark interest rate. It is basically used as a benchmark interest rate that is used to determine the cost of, borrowing for many financial instruments, which is used to determine the cost of borrowings for many financial instruments like loans, mortgages, as well as derivatives. Loans, mortgages, as well as derivatives. What is it? Sir, it is the average rate of interest at which major banks in London. What is it? Sir, it is basically the average rate of interest. It is basically the average rate of interest on which major banks in London are willing to borrow as well as lend unsecured loan within themselves. Unsecured loan within themselves. Banks, private companies, they are using Libor. They are using Libor as a benchmark to decide the rate of interest for raising the funds. Is it this point clear? So है क्या सब बैंक Libor क्या, जैसे कि हम जानते हैं about लंदन, तो लंदन में बहुत सारे बैंक्स हैं, तो लंदन में जो बड़े बड़े बैंक्स हैं वो जिस रेट पर आपस में ट्रांजैक्शन करने के लिए तैयार है उसके बेसिस पर लिबोर को डिसाइड किया जाता है। और ये जो लिबोर है ये सिर्फ इंटरबैंक के लिए नहीं, उसके अलावा ऑल ओवर द ग्लोब अलग अलग ट्रांजैक्शंस को परफॉर्म करने के लिए इसे एज अ बेंचमार्क यूज किया जाता है। लिबोर इज डिसाइडेड ऑन द बेसिस ऑफ इंटरबैंक बोरोइंग, but that borrowing is not only related to UK pound. That is not related only to UK pound. Sir, यहाँ जो banks हैं, they are ready to borrow as well as lend not only the UK sterling pounds but also Swiss franc, currency of Switzerland, Euro, currency of Eurozone, Japanese yen, currency of Japan, and US dollars. Second point. So it is based on 5 currencies. Second point. It is calculated on 7 maturities. 7 maturities means first is overnight, that is 24 hours. Second is 1 week. Third is 1 month. Fourth is 2 months. Third is 5 months. Then 6 months, and then we have 12 months. Is this point clear? Is this point clear? So we have 7 maturities. This rate of interest is given for 7 maturities. The first one we have is overnight. That is 24 hours. Libor is presented for 1 week. Libor is presented for 1 week. Libor is presented for 1 month. Libor is presented for 2 months, for 3 months, for 6 months, as well as 12 months. So in total, Libor is presented for 7 different time periods, for 7 different maturity periods on the basis of 5 different currencies. On the basis of what? Sir, on the basis of 5 different currencies. Is it clear till this point? Is it clear till this point? Now you must be getting that point that why Libor is treated as an international benchmark, because it is not only calculated on one currency, rather it is calculated on n number of currencies. Rather it is calculated on n number of currencies, and not only it is calculated on n number of currencies, it is also calculated for different maturities. It is also calculated for different maturities. Is it clear till this point? Is it clear till this point? If it is clear, just give me yes sir, then we'll move ahead. If it is clear, just give me yes sir, then we will move ahead. The next point is again going to be really very important. So now we have discussed what is basically Libor. Once Libor is clear, what is the next point we need to understand? So the next point we need to understand in case of Libor, is, sir, it is calculated on how many currencies, and it is calculated for 5 currencies, and it is calculated For how many maturities? Sir, it is calculated for 7 maturities. Now the question is, so who publishes Libor? Sir, Libor is published by Intercontinental Exchange. Intercontinental Exchange, that is ICE, and it is based on the submission from a panel of major banks. It is based on the submission from a panel of major banks. So if you remember in the starting itself, I have given you this point that it is published by ICE Benchmark Administration, which is even termed as IBA. So ICE is what? Sir, it is Intercontinental Exchange. ICE is an American company that owns and operates financial and commodity marketplaces and exchanges. So what is ICE? Sir, it is nothing but it is an American company that not only owns but it also operates the financial company as well as it operates the financial and commodity marketplaces and exchanges in the world, especially in US. It was founded in May 2000 in Atlanta, Georgia. I hope you know that Georgia is a part of US. ICE operations include what? Sir, it include future exchanges, cash exchanges, central clearing houses, market services, and many more. These are the services which are included under the case of ICE. Now the question is very important. Sir, how Libor is calculated? See, try to understand this point, how Libor is calculated. Sir, in order to calculate Libor, what happens is 18 international banks, they come together and they give their rates. They give their rates that if I have to borrow overnight funds, if I have to borrow funds for 3 months, for 6 months, for 9 months, for 12 months, what interest rate I am ready to pay. What interest rate I am ready to pay. Similarly, the same is given by rest of the 17 banks. Now the data, when it is received from 18 international banks, it gives us an idea, but this is not the ultimate calculation. How the calculation is done? So when this data is collected, after collecting the data, the extreme highs and lows are ignored, which means the highest rate which a bank is ready to receive and the lowest rate the bank is ready to pay, those rates are ignored and the left out rates are taken as a barrier. So ICE strips out 4 highest submissions given by different banks and 4 lowest submissions given by different banks. So they cut down first 4 highest ones, they cut down last 4 lowest ones, and the left out rates, their average is taken, and the average of the left out rate is known as what? So the average is known as Libor. I assure you, no one is going to discuss this part in so much detail. I can assure you. So next time if someone asks you how Libor is calculated, I'm pretty sure you will be in a position. To answer how Libor is calculated. So Libor is calculated by 18 international banks. First of all, they come up, 18 international banks, they present that at what rate they are ready to borrow the funds. So once those rates are submitted by 18 banks, then those 18 banks rates, their list is prepared, and out of the list, top 4 or highest 4 rates are ignored, lowest 4 rates are ignored or they are striked out, and left out rates, we calculate the average. So it should be noted that Libor is not set on what banks actually pay to borrow the funds from each other. So it is not set on what they actually pay, it is set on what they are ready to pay. This point is really very important. Libor is not set on the basis of rates which a bank is actually paying to borrow or lend funds. Rather, it is calculated on the basis of the rates which they are ready to pay, which they are ready to receive at the time of borrowing. Is it clear? Moving on to the next point. Now, instead, it is based on the submissions related to what they think they would pay. As a result, the question is, it is not calculated on the rates which is actually paid, rather it is calculated on the rates which they are ready to pay, which they will be paying in near future, but there is a possibility of what? So there is a possibility of fraud, there is a possibility of manipulation. So this is the point because of which Libor has witnessed, or I would say the importance of Libor has decreased over the period of time. Why the importance of Libor has decreased over the period of time? So the answer is pretty clear. The answer is pretty clear. And what is the answer? So the answer is the importance of Libor has decreased over the period of time because it is based on the rates which bank is ready to pay, but they are not actually paying. And if they are not actually paying, they can easily manipulate the rates which they are submitting just to calculate the Libor wala part. Just to calculate the Libor wala part. Is it clear, everyone? Now, while Libor is being phased out, why we have removed Libor? Sir, Libor was replaced because of the, undoubtedly, there is a possibility of manipulation because banks, they give those rates on which they are ready to borrow the funds, but they are not actually borrowing, they are not actually paying. In 2012, there was a scandal revealed where several banks, those international banks, those 18 international banks, out of those 18 international banks, several banks, they made a custodian, they made a group, and then they decided to manipulate, the rates they are going to submit, which will undoubtedly give a manipulated Libor, which will be helpful for them in order to make profit in the near future. Second is, Libor has played a significant role in 2008 financial crisis as it was used as a benchmark rate for many financial instruments, including mortgages, loans, and derivatives. And we are relying on the rate, which is not the actual rate. It is just on the basis of the expectations, and expectations cannot be reality. And in order to overcome expectations and match it to the reality, Libor is required to be phased out. The last is accuracy of Libor and its ability to reflect true market condition. The interbank lending market that Libor was designed to reflect become less active in the recent years. In the recent years, we have witnessed there are very less transactions in terms of interbank borrowing and lending because of n number of venues offered by the central banks of the countries, as well as the availability of n number of instruments through which banks they can easily borrow from the public rather than borrowing from other banks, from the other financial institutes. So second is their popularity has reduced, and because of reduced popularity, undoubtedly, if you are saying that I'm ready to borrow interbank loan for 24 hours at 8%, but actually there is no borrowing or lending done in the economy, so your expectation has nothing to do, or it is not going to govern the actual day-to-day operations. That is the reason it was phased out. Last is, regulators around the world are developing new benchmark rates. For example, the moment it was clear that Libor is a manipulated rate, US came in the picture, and US has come up with secured overnight financing rate to replace Libor. This benchmark is based on the rates US financial institutions they pay to each other for overnight loans. Not only this, US come up with sterling overnight index average, which we can call it as SONIA, but it is sterling overnight index average, and it is going to replace Libor in the near future. The next one we have is, in India, the new transactions were recommended. Also recommended on the basis of same. Now India is also in the race with the introduction of a term that is SORR, which we will be discussing in some time. But before that, the next point is, so what is the alternative to Libor? Now, if you say do not follow Libor, fine, we will not follow it. Then give us an alternative. What we should follow if we are not following Libor? Then the answer is, in 2007, US Federal Reserve has introduced SOFR, that is secured overnight financing rates. These are the rates which are used by US based financial institutions for overnight day-to-day transactions. In India, new transactions were recommended to use SOFR along with the modified Mumbai Interbank Offer Overnight Rate, replacing Mumbai Interbank Forward Overnight Rate. What is it? See, as I said, in India, interbank transactions were done on interbank offer rate, Mumbai Interbank offer rate or Mumbai Interbank bid rate. And on the basis of these rates, rates were decided for forward market as well. But in 2017, RBI has asked the banks and the India's financial institutions, financial players, that you should follow SOFR. Along with modified Mumbai Interbank forward offer rate in order to decide the interbank rates, in order to decide the derivative rates, rather than following Mumbai Interbank offer rate or following Mumbai Interbank forward offer rate, which is based on MIBOR. SOFR is based on observable repo rates. So these rates reflect the cost of borrowing cash overnight and are collateralized by US Treasury securities. So basically, unlike Libor, where the calculation is done on the basis of expectations, now the calculation is done on reality. What reality they are saying? They are saying that SOFR, which is a US based rate, it is calculated on the basis of cost of borrowing cash overnight and are collateralized by US Treasury securities. Unlike Libor, which relied on the expert judgment, SORF is derived from actual transactions. So unlike Libor, which is based on the judgment, SOFR is basically based on the actual rates which are used in the day-to-day operations in US market by the US financial institutions to borrow and lend funds. Remember that modified Mumbai Interbank forward offer rate, on the other hand, incorporates the adjusted SOFR rates, which are compounded retrospectively for different time periods. So what does it basically mean, sir? MMIFOR, on the other hand, incorporates adjusted SOFR rates. What is adjusted FOR rates? Sir, adjusted FOR rates are those rates which are calculated respectively, or I would say retrospectively for different time periods. So these time periods or these rates, they are obtained from Bloomberg Index Services, among the other components, and many more. So the introduction of SOFR and modified Mumbai Interbank forward offer rate aims to provide more reliable based transactions in the country, and rather than relying on Libor, which is a kind of rate which can be easily manipulated all over the globe. Now, you said, or RBI is saying, that you should shift from Libor, but it's not easy to shift from Libor, because Libor is something on which we are relying from past decades, not only years, from past few decades. So what is going to happen? So there are many products linked to Libor, and redesigning them and linking them to alternate reference rate as the base is going to be difficult. Now, what is alternate reference rates? Or alternate reference rate is basically the rate which you as a country is opting at place of Libor. So whenever you replace Libor and against Libor, you are following another rate. That rate is basically termed as, in general, alternate reference rate. For example, SOFR is alternate reference rate. Similarly, SONIA, which we discussed for UK, is also an alternate reference rate. So two working groups constituted by associations receiving guidance from RBI helped to develop the same. So two working organizations, they have developed the same. Remember that the transitioning from Libor to ARR, it has n number of challenges, which include technological challenges as well as legal challenges, and these challenges involve dealing with existing contracts, making necessary modifications with the counterparties, interbank entities and borrowers. So banks, they need to undertake essential systematic and technical changes so that they can shift all their existing contracts to the new rate, which is termed as ARR, that is alternative reference rate. The last point from where I will be concluding my discussion is, banks need to continue their efforts where they are redesigning products linked to Libor. Now they are being linked to ARR. The two working groups, as I already discussed, has been set up to take these crucial decisions to overall to overcome the challenges in technology and legal aspects. Bank must focus on handling the existing contracts in an appropriate manner. Now, here comes up with the most important part. The most important part over here is, so what do you understand by the term that is SORR? Anyone out there, those who are listening to me, in the comment section, can you give me what is the meaning of, or SORR stands for what? Any idea, guys? So this is the term which has been introduced by RBI recently in the latest RBI monetary policy. If I say the RBI former governor, 25th governor of RBI, Shaktikanta Das ji, has introduced this term SORR. But can you give me what is SORR? Can you give me what is SORR? Any idea? If you can just give me full form, that is more than sufficient for me. I can move ahead. See, SORR is basically, RBI has introduced SORR, which stands for secured overnight rupee rate. It is basically secured overnight rupee rate. Now the question is, what is it? What is the meaning of secured overnight rupee rate? How you define this particular term? Then I would say it is basically a new interest rate. It is basically a new interest rate benchmark. It is basically a new interest rate benchmark which is going to replace Mumbai Interbank Offer Rate. Remember that it is based on secured transactions like market repo as well as tri-party repo transactions, and this SORR, it offers a trade-based, transparent and manipulation-resistant methodology which will help RBI to make the transactions in a better manner. So I would repeat, Reserve Bank of India has announced the development of secured overnight rupee rate. And if I talk about the secured overnight rupee rate, I would say it's a new benchmark for interest rate derivative market, which is going to be based on secured money market transactions like market repo and tri-party repo. So SORR is going to be developed with support from Financial Benchmark India Limited, which aims to offer a trade-based, robust and manipulation-resistant benchmark which will reflect market dynamics of the country, and it will, I would say, it will decrease the dependency on MIBOR, as well as it will give us a more stable rate, less manipulative rate, and a rate which is less prone to n number of manipulations which can be done. So this initiative aligns with the global best practice which we have just discussed, that is SOFR, which stands for Secured Financing Rate, and this signals that yes, India is now trying its level best to shift from MIBOR to SORR to SOFR in a full-fledged manner. Is it clear? Now, if someone asks me, sir, what do you understand by the term MIBOR? So MIBOR is Mumbai Interbank Offer Rate. It is used since 1998, and it is a pooled rate which is derived from averaging responses from the market participants. But on the other side, SORR, so SORR is based on actual. SORR is basically based on what? So SORR is going to be basically based on, actual secured transactions in the overnight repo rate, market, which cover almost 98%. Yes, which covers almost 98% of the overnight market activities, which ensures high reliability, as well as it is less, I would say, suspectability, as well as less capability of manipulation. So this SORR is aligned to SOFR, which will help India to follow an alternative resistance rate or alternative reference rate like other nations are already doing, for example US, for example UK, for example Eurozone and many other countries. Is it clear everyone? So this is SORR. The next is SOFR. The first one was LIBOR. If all these terms which we have just discussed are crystal clear, just give me yes sir. I assure you, if you have this much knowledge related to this particular topic, you will be in a position to answer all the questions in your upcoming examination. If you want to learn all the concepts in same way and up to the same depth, up to same, I would say, up to same level of discussion you need for each and every topic so that you can clear your upcoming examination, then you should join our Lakshya Batch 2.0. This is the batch which we have launched after the immense success of RBI Grade B Lakshya Batch 1.0, and this batch is going to help you all to clear not only your RBI Grade B examination but almost all the regulatory body exams, where we will help you to prepare for phase 1, phase 2 as well as interview stage, which means we'll hold your hand from day 1 till the last day, till the day you enter RBI as a Grade B officer. We are going to provide you with 550 plus live classes, 220 plus mock tests, one-to-one mentorship, and most importantly, we'll give you exam-like feeling, exam-like experience for your descriptive section. So do use the code MADHAV if you are subscribing to our Lakshya Batch, or if you are subscribing to any course available on the Testbook application. So thank you so much for joining, guys. We'll catch you in the next session. Hope you must have understood insights related to IBOR, related to ARR, related to SOFR as well as SORR. If you still have any doubt, do write your doubt in the comment sections. I'll try my level best to answer each and every doubt of yours in the comment section itself. Thank you so much for joining, guys. We'll catch you in the next session. Till then, stay home. Take care, guys. Good luck. God bless you all. Bye-bye. Take care. I hope you must have enjoyed the discussion. If you have any doubt, you can ask me in the next session for sure. You can write your doubts in the comment section as well. Good luck. Bye-bye. Take care.